His balance was $225,000 the last time we talked. But when he called me, it was $180,000. It was down $45,000 gone just in a few weeks. And he didn't do anything wrong. He followed the playbook perfectly. A client called me a few weeks ago with a question that he didn't want to ask. A guy I've worked with and have known for a really long time. Good guy, does everything right, makes his 401k contributions every year, maxes it out, dollar cost averages, stays the course, doesn't panic, doesn't chase returns, everything his financial advisor told him to do. He did. His balance was $225,000 the last time we talked. But when he called me, it was $180,000. It was down $45,000 gone just in a few weeks. And he didn't do anything wrong. He followed the playbook perfectly. But he asked me one question, Barry, is this really how things are supposed to work? And the honest answer is, yeah, it is. That's how it's supposed to work, because the system he's inside was never designed to protect him. It was designed to accumulate a pile of money and hope the pile of money lasts. And when the market takes 20% of your pile in just a short while, the system has no answer. It just says, stay the course. And I know how that feels because in 2008, I learned the same lesson, except it cost me $1.4 million. I was a real estate investor, had a large portfolio, trusted investment company in Las Vegas, managed over $100 million. My clients were getting 12 to 18% returns. Everything looked incredible. And everyone around me was saying there's no bubble. Vegas is going to keep growing. Then the housing market dropped 50%. I lost the real estate. I lost the cash, multiple foreclosures. I was over-leveraged, surrounded by one-sided voices, and I had zero guaranteed assets in my portfolio. Nothing that held its value when everything else collapsed. Some mornings, I couldn't get out of bed. It was depressing. It was frustrating. And here's what still gets me. For years before the real estate, I'd spent years selling market-based investments. Licensed in 2001, I left that world when I started losing sleep over what the market was doing to my clients' money. Moved into real estate looking for something better, and then real estate took me down too. Just so frustrating. Had I built what I've built since, had I known what I know now, the crash would have been survivable. I would have had liquidity when credit froze. I would have been buying foreclosures instead of losing to them. Nobody taught me. I didn't know it existed. That was 18 years ago. Everything I've built since then is built around one principle. Never be without what would have saved me in 2008. That's what I'm going to show you today. So let me tell you what I've built in the 18 years since and why I'm telling you about it today. Financial freedom means one thing. Your passive income exceeds what it costs you to live. Robert Kiyosaki called it escaping the rat race. When that happens, you're free. Whether that means you retire next Tuesday or whether it means you keep doing work you love for the next 30 years and never worry about money again, that's your call. Maybe you're grinding right now and you can't wait to be done. Maybe you love what you do and the last thing you want to do is stop. Either way, the goal is the same. The work becomes optional. You wake up on a Monday and you go because you want to go, not because the mortgage needs you to. When work becomes optional, everything changes. The deals you take, the clients you accept, the risks you're willing to walk away from, the time you spend with your family. Kiyosaki's principle was pay yourself first. Build assets that produce income instead of liabilities that consume it. And that's what I'm going to show you how to do today. The conventional path says getting there takes 40 years. I'm going to show you how to get there in 10. Not by working harder or earning more, but by building a completely different kind of infrastructure underneath your financial life. Let's start with why the conventional path doesn't work. My client with the $225,000 that became $180,000, he's not an unusual case. That's what happens to people's retirement accounts during every major market drawdown. It happened in 2008, it happened in 2000, It happened in 2020 for about 3 weeks before they printed enough money to paper over it. And it'll happen again. No one knows when, but it will happen. This isn't bad luck. It's architecture. The entire 401k system is built on one idea: accumulate a pile of money over 40 years and then spend it down until you die. That's the plan. That's what your advisor is building for you, a pile that depletes. Let me show you the math your advisor doesn't walk you through. If you want $10,000 a month in retirement, which is not a lavish lifestyle, that's a mortgage, couple of car payments, groceries, health insurance, nothing extravagant. You need $3 million in your 401k. $3 million, not earned, not income, a pile of money sitting there. And the plan is to spend it down until you die, hoping the pile lasts longer than you do. $3 million. And at average market returns with the tax drag on a 401k, getting to $3 million takes 35 to 40 years of maxing out your contributions. That's assuming the market cooperates. That's assuming no major drawdowns at the wrong time. That's assuming you don't need the money for anything else along the way. And even if you get there, even if you hit the $3 million after 40 years, you're spending it down. Every year you withdraw, the pile of money gets smaller. You're in a race between your spending and your death, and you're hoping the money outlasts you. That's not freedom. That's a countdown. Now, here's the part that really gets people. It's called sequence of returns risk, and almost nobody talks about it. Remember the client that I told you about here in the beginning, the $225,000 that became $180,000? He's not retired yet, so his 20% drop is painful but survivable. He's got time. The market might recover before he needs the money. That's how accumulation works when you're still years from needing the money. But what if he had been retired when it dropped? What if that $225,000 was his whole plan? Same person, same portfolio, same 20% drop, but the drop happens in year 1 of retirement instead of year 10 of accumulation. Now he needs his withdrawals to live on. He's pulling money out of a shrinking pile. For that portfolio to recover and sustain his withdrawals for the next 25 years, the market doesn't just need to bounce back. It needs to significantly outperform historical averages for years. And it needs to do that while he's pulling money out of it every month. The math on this is devastating. A 20% drop in year 1 of retirement can mean running out of money 10 to 15 years earlier than planned. Same guy, same bad year, different place in the timeline, that sequence of returns risk. And nobody tells you about it until you're already inside it. That's the system. That's the architecture. It doesn't matter if you're making $50,000 a year or $500,000 a year. The architecture is the same. You accumulate a pile, you hope it's big enough, you spend it down, and you pray you don't run out. So that's the conventional path. 40 years of accumulating, a pile that depletes, a race between spending and death, and the ever-present risk that the market drops at the worst possible time and takes 20% of your future with it. I lived inside that system. I sold it to clients. I believed it. And in 2008, it cost me $1.4 million. What I'm about to show you is what I built after the crash. It compresses the timeline from 40 years to 10, not by working harder or saving more, but by building a completely different kind of infrastructure underneath your financial life. There are 3 gears to this system, and all 3 have to work together. Let me show you what they are. The system that compresses 40 years into 10 years has 3 gears. I'm going to walk you through each one of them today and show you exactly how they work. But first, I want you to see the whole picture so you understand where we're headed. Gear 1 is the banking infrastructure, the foundation underneath everything else. This is the piece I didn't have in 2008. It's the guaranteed, liquid, tax advantage asset that holds its value when everything else drops, that gives you access to capital without asking a bank's permission, and that compounds every year with no down years. This is the engine that makes the other 2 gears possible. Gear 2 is cash flowing real estate, the income engine. This is what produces the monthly passive income that eventually exceeds your monthly need. I've been investing in real estate for over 17 years. I've seen what works and what doesn't, and what works is rental real estate acquired with the right capital structure, which is what Gear 1 provides. Gear 3 is tax-free income for life, the perpetual harvest. This is the end state, the point where your banking infrastructure and your real estate portfolio together produce enough income to cover your life, and the income doesn't deplete because the system was built to compound rather than to spend down. This is what the 401k was supposed to deliver and structurally cannot. Any one of these gears alone is insufficient. Real estate without the banking infrastructure, that's what I had in 2008. It was leverage without a safety net. The banking infrastructure without real estate is a savings vehicle without an income engine. Tax-free income without the first two gears is a promise with nothing underneath it. All three together is the system, and the system compresses 40 years into 10. Let me start with Gear 1 because Gear 1 is the piece that changes everything. Before I show you how it's built, I do want you to know something. This isn't my invention. This isn't some alternative strategy I came up with in my garage. Banks do this with their own money. It's called bank-owned life insurance. And there's over 200 billion of it sitting in U.S. bank balance sheets right now. Fortune 500 companies do it for their executives. Matter of fact, the University of Michigan restructured Jim Harbaugh's entire contract around it. It made him the highest paid coach in college football, and the compensation was designed to deliver millions in tax-free retirement income. The difference between what they're doing and what most people are doing is that they know about it and you don't. They use it for themselves and they don't tell you about it. Today, I'm telling you about it. The investors who came through 2008 intact were not the ones with the best properties. They were not the ones with the highest net worth. They were the ones who had a banking system they controlled, liquidity that didn't depend on credit markets, an asset that didn't lose value when the market dropped 50%. I didn't have that, and it cost me $1.4 million. What I'm about to show you is what that banking system looks like and exactly how it works. It starts with a properly structured high cash value whole life insurance policy. Down here is what we would call the base premium. And this is where 95% of agents are going to put all your premium because it's purchasing a lot of life insurance. And frankly, it's how we as insurance agents get compensated on base premium. The more base premium, the more life insurance you're purchasing, the larger commission to the agent. You get a lot of life insurance here, but the cash value, the part that you can actually use while you're alive, is very minimal, and it takes years to build up if you're only funding base premium. And these policies feel really expensive because all of your money is going to life insurance. Rather than all of your money going to base premium, we do the opposite. We want the majority of your money going into what's called PUA, paid up additions. This is turbocharging the cash value. I'm going to put several dollar signs here and only $1 here. PUA equals cash value. What we want to do is minimize the base premium and maximize the cash value. In a properly structured policy, what I'm showing you right now, the majority of your money is going to cash value. This is money that you can use in your banking infrastructure. You don't have to wait 5 or 10 years for that cash value to build up. You'll see immediate cash value in the very first year. This is what a properly designed policy looks like. With most agents, though, your money disappears into death benefit, and it takes years to build up cash value. Properly structured, the majority of your premium goes directly to cash value. Now, there is a limit. At the top of this line is what's called the MEC limit. You don't want to exceed the MEC limit. We want to fund the PUA right up to the MEC line, but we don't want to cross it. Keeping your PUA under the MEC limit allows you to use all this money 100% tax-free. If you ever want to put more money into a policy than the MEC limit, you simply start a second policy. Think of it like opening another branch. Another policy would be another branch of your bank, and you can keep adding policies as you see fit. You're expanding your banking system. Let's look at some real numbers and how a properly structured policy works. I've run this illustration on Travis Kelce, age 36 at Preferred Plus, and we're showing $50,000 a year going into the policy. The premium amount you choose to put in, that's up to you. The numbers here are very linear. So if you want to double it or triple it or cut it in half, you would do the same thing here with the numbers. There is a guaranteed growth rate in the cash value and a non-guaranteed rate. The guaranteed cash value and death benefit don't include the dividend, whereas the non-guaranteed values do include the dividend. We see here when the $50,000 goes in, the cash value that's guaranteed is $40,228. Just over 80% of the premium is going into cash. And then with this $957 dividend, the non-guaranteed cash value is $41,186. And every year that goes by, that cash value continues to grow. We see the cash value getting larger, the dividend getting larger, and the increase in cash value is always going up because of compound interest. Guaranteed return, dividends are paid annually, compound growth of your money throughout the life of the policy. This policy on Travis is funded for 10 years, and you can see here starting year 11, there's no more money going into the policy. Yet the cash value continues to grow every year, $34,000, $40,000, $51,000, and that's growth that will continue even after you stop funding. You could fund a policy for 10 years, 15 years, 20 years. This is a flexible premium. You can pay a lower amount. You can fund for 7 years, 15 years, 20 years. That flexibility gives you more peace of mind. You'll also notice there's a death benefit over here that's growing. $1.3 million. By the time you get to year 20, it's $2.1 million, which is a legacy that can be left, or you can also spend down money in retirement. We're going to get to that in a minute. This is an asset. It's providing you guaranteed growth, access to liquid cash, tax-free use of your money, and a permanent death benefit. Let's say Travis wants to take a policy loan in year 4. There's $192,000 here. Let me show you how that works. We said the cash value was $192,000. And let's say Travis wants to take a loan for $100,000. He can use that $100,000 for whatever he wants. He can invest in business, buy real estate, buy crypto, alternative investments. Insurance company doesn't care. No credit check, no application, no stack of documents to sign. No 30 or 45 days of waiting. You log into the insurance company portal, fill out a form, takes a few minutes, and within 3 to 7 business days, the money is deposited in your bank account. That's it. Compare that to what you go through to get a bank loan. They want your tax returns, your statements, your profit and loss schedules, your balance sheets. This is a different world. Now pay attention because this is where it gets really powerful. The great thing about this is the insurance company does not remove the $100,000 from the $192,000. The full $192,000 continues to grow. The insurance company doesn't physically remove the $100,000 from Travis's policy. They give him a loan from their general account. He still has money there that he could loan against if he wanted to, but he's still earning interest and dividends on the total $192,000. That means his money is working for him in 2 places at the same time. Let me show you how the math works on the policy loan. He's going to pay it back. The current loan rate is 5.3%. That interest does go back to the insurance company. So let's assume here we've got 0. The loan is taken, and Travis is going to pay this loan back over time. We're going to see that there's principal reduction happening. In my loan calculator, we have the $100,000 at the 5.3% interest, and he's going to pay it back over 60 months. So the loan payment is $1,900. And every month that he makes that payment back, the balance of the loan is going down. You see that here, which means the amount of interest that's being charged is also going down over time because there's a lower loan balance. At the end of 5 years, he would have paid right here $14,000 of interest back to the insurance company. So let's show that here, 14,000 interest back to the insurance company. But remember, the $100,000 wasn't physically removed from Travis's policy. They put a lien against it, but he was still earning interest and dividends on the total cash value. Travis's policy is earning around a 5% net tax-free return. So knowing that that money is still being accrued at 5%, let's do the math on this. Present value of $100,000. We're going to use the same 60 months at 5%, which means on the $100,000 just by itself, it grew to $128,000. The difference between the $128,000 and the $100,000 is $28,000. So even though he had a loan out for the $100,000, his cash value on that $100,000 grew by $28,000. He only paid $14,000 in interest. What that means is if we take $14,000 away from $28,000, he still came out a positive $14,000 by using his banking infrastructure and taking a policy loan from his high cash value, properly structured policy. You see, along the way, there was no lost opportunity cost. Travis was still earning interest and dividends on his full $100,000. If you take that money out, you physically withdraw that money from a 401k, an IRA, a brokerage account, a savings account, a CD, that money is gone. It's no longer working for you. Here in the policy, there is no lost opportunity cost. The other great thing about this is you get to choose the loan payback. The insurance company doesn't force you what to pay back. You get to pay back the loan however you want. And let's say you had a lease. You're leasing equipment for your business, and that lease on the back end might be 12 to 18%. Well, what I recommend is take a policy loan, pay the 5.3% to the insurance company, but still pay your loan back at the 12% or the 18%, whatever that might be, and now you earn the difference. Rather than the third-party lender making that interest, you get to arbitrage. You get to make the difference between the 5.3% and the 12%. That money can go back into your cash value, or it can accelerate the payback of the loan balance. You're the bank. You get to choose the terms. You get to choose the payback. You get to capitalize on this money in your own policy. I want to give you some real examples of how this works in practice, because the math is one thing, but seeing it in someone's actual life is another. Years ago, I had a friend that got into some financial trouble, and for 2.5 years, he didn't have any income. He had these policies in place. He was taking loans to sustain himself through that difficult 2.5-year time frame. He didn't have to max out credit cards. He wasn't fire selling assets. He wasn't calling the bank for personal loans. He had this foundation in his life, and it sustained him for 2.5 years until he got back on his feet. Not only can the policy help you to invest in other assets, but it's also a security. It gives you that foundation. It's a buffer for hard times. In my friend's case, saved him, saved his family. It was a tremendous asset during a difficult time in his life. That's what this banking infrastructure does for you. It's there for you when everything else isn't. I want to tell you about a real estate investor client of mine in New Jersey. His name is Michael. He opened 2 of these policies in 2021, and since then he's used his banking infrastructure in 3 different ways. He's paid off high interest rate mortgages with a loan at 5%. He's funded a $33,000 rehab down payment without going to a bank. and cleared a credit card balance when the 0% promo rate expired. Same infrastructure, 3 completely different jobs. That's what it means to have your own banking system. And look, one more thing before we move on, and I want to be honest about this because it matters. I've had several clients die young. 39-year-old, a 51-year-old, 41-year-old, neither of them plan to die, nobody does, but their families were protected because these policies were in place. The death benefit, which in a properly structured policy we minimize so we can maximize cash value, it was still there, and it was tax-free, and it went to their families when they needed it most. I don't want you to think about this banking infrastructure as just a retirement tool or just a real estate tool. It's also the thing that protects your family if you don't make it to retirement. The death benefit is real. I've seen it matter. I've made those calls to families, and I can tell you that the families who had this in place were in a very different position than the families who didn't. So gear 1 is the foundation. Gear 2 is what you built on top of it. I've been investing in real estate for over 17 years. I grew up watching my parents do it. I've done trust deeds, flips, rehabs, buy and holds, foreclosure acquisitions. I made a lot of money in real estate, and I've lost a lot of money in real estate. What I know after 17 years is that real estate is the most reliable income engine available to an individual investor, but only if the capital structure underneath it is right. When the capital structure is wrong, when you're over-leveraged, when you're dependent on bank financing, when you don't have liquidity, real estate is a trap. That's what 2008 taught me. The investors who got destroyed weren't bad investors. They were investors with the wrong infrastructure underneath their properties. When the capital structure is right, when you have your own banking system, when you can access capital without a bank's permission, when your liquidity is guaranteed regardless of what the credit markets are doing, real estate becomes the most powerful wealth building tool on the planet. Let me show you what that looks like in practice. In 2022, I purchased an 1,800 square foot property in Logan, Utah. Main house, 3 bedrooms, 1 bath, plus a smaller back house, 900 square feet, 1 bedroom, 1 bath. Logan is a college town, home of Utah State University, hot rental market. I bought the property for $500,000 with $355,000 in bank financing. The down payment came from my cash reserves and a policy loan from my banking infrastructure. Here's what matters about that deal. I was cash flow positive from day one, even while paying both the bank loan on the property and the policy loan back to my insurance company. And the policy loan didn't affect my cash value growth. My money was working in 2 places at the same time. The real estate was producing rental income and appreciating, and my cash value was still compounding inside the policy as if I'd never taken the loan. That's what velocity money means. Your capital doing 2 jobs simultaneously because the banking infrastructure makes it possible. Here's another example. I had a client, a real estate investor, who found an amazing deal on a discounted property. She wanted to move fast because she didn't have enough cash on hand. I reminded her she could take a policy loan from her banking infrastructure. The loan rate was only 4.67%. Her cash kept compounding at the full rate. The property was cash flow positive. Her cash on cash return was in the double digits. And down the road, she could do a cash out refinance to pull her equity out and go buy the next property. That's the cycle. Buy with policy loan capital, refinance, repay the loan, repeat. Every time you go through the cycle, you own more real estate, you produce more passive income, and your banking infrastructure is restored and ready for the next deal. That's gear 2. Real estate producing passive income, powered by gear 1's banking infrastructure, building toward the moment when the passive income exceeds your monthly need and you've escaped the rat race. Now let's talk about what this looks like at the finish line. Because gear 1 and gear 2 are the building phase, gear 3 is when the building pays off. So let's look at gear 3, tax-free income. In Travis's example, $50,000 a year for 10 years, so total outlay is $500,000. And at the age of 65, he's going to begin to take out income of $110,000 a year through the age of 85. So when we do the math on this, $110,000 a year for 21 years, we come out with $2.31 million. He only put in $500,000, so he more than 4x's his total income coming out. And remember, that's tax-free. 2.3 million, depending on your tax bracket, is going to feel like 2.9 to 3.4 million. In this case, 2.3 million completely tax-free, and only 500,000 went into the policy. If Travis passes away at the age of 85, there is still $1 million death benefit that would go to his beneficiaries tax-free. What a phenomenal plan. 500,000 in, 2.3 million taken out, and another million left over to beneficiaries, all without having the IRS or the government hound you about taxes. If done correctly, this total of 4.3 million can come to you and your family 100% tax-free. Again, the power of properly structured high cash value whole life insurance and your banking infrastructure. In the Travis Kelce high cash value illustration example, I showed 3 phases. Phase 1, the funding years, putting in $50,000 a year for 10 years and then stopping. Phase 2, banking and income. He could take policy loans $100,000, $200,000, $300,000, and the income produced $110,000 per year, $2.3 million total tax-free income on only a $500,000 contribution. Phase 3, death benefit. Depending on how long Travis lives, the money he takes out, that death benefit can range from $1 million tax-free to his beneficiaries all the way up to $7 million. Whether you're making $14 million a year like Travis Kelce or $140,000 a year like a lot of people I work with, the architecture is the same. The structure doesn't care about the size. It cares about the design. What I just showed you works at any income level. The numbers scale, the design doesn't change. And here's what I want you to see. The 401k gives you one thing, a pile that depletes. What I showed you in the Travis Kelce illustration gives you 3 things. Banking infrastructure you can use your entire life, tax-free income that doesn't deplete, and a death benefit that protects your family whether you live to 90 or die tomorrow. 3 things instead of 1. And the 3 things work together. The banking infrastructure compounds while you're using it, the income is tax-free because of how the policy is structured, and the death benefit is there from day 1. That's not a product. That's a different architecture for your entire financial life. Let me lay out a timeline for you because I want you to see how this all comes together. You'll recall I mentioned in year 1, this $41,000 is over 80% of your premium going to cash. Just before year 5, the policy breaks even, meaning the amount of money you put in, you now have more cash value than that total amount. Year 6, 7, 8, 9, 10, and forward, things really begin to pick up. And the great thing about this is you're always making more money from one year to the next in those funding years. And come year 11, there's no more money going in, but the cash value continues to grow and accelerate. This is aggressive cash value growth. No more funding, but you're getting a rate of return that's tax-free, guarantees, and compound growth on that money. And all throughout this time frame, you now have an asset that you can leverage. You can move it into real estate. You can move it into your business. You can use it to perpetuate family generational wealth as a family banking infrastructure. The goal is to keep money in motion. That velocity of money and keeping it in motion allows you to create more wealth throughout your lifetime. And once you hit this crossover in just 5 years, now we're talking about passive money because your cash value is growing by more than the premium amount you're putting in. And that amount is getting larger and larger. You're on your way to that financial freedom in 10 years. What I can show you is what the system looks like at different stages. And you've already met 3 of the people inside it today. You remember Michael from earlier, 3 years in, running 3 banking functions through his infrastructure: the mortgage payoff, the rehab down payment, the credit card transfer. He's in the deployment phase. His banking system is built, and he's using it in multiple ways simultaneously, which is what the 3rd and 4th years tend to look like. The real estate investor I told you about, the one who grabbed the discounted property, she's 11 years in, cycling policy capital through one property after another. Buy with policy loan, refinance, repay, repeat. Every year she owns more real estate, produces more passive income, and her banking infrastructure is restored and ready for the next deal. That's what the middle years look like when Gear 1 and Gear 2 are working together the way they're supposed to. And the friend I mentioned, the one who lived on his cash value for 2.5 years when he lost his job, his infrastructure was already built when he needed it. That's the resilience case. That's what it looks like when the system is in place before the emergency arrives instead of after. 3 clients, 3 stages, same system, different points on the same timeline. That's what 10 years actually looks like from the inside. Not a hypothetical projection, real people at real stages building real infrastructure, moving toward the crossover where passive income exceeds what it costs them to live. At which point, the work becomes optional and they've escaped the rat race. So let me bring this together. You came in today inside a system, the system most people use: save in a 401k, contribute for 40 years, accumulate a pile, and spend it down hoping it lasts. I lived inside that system. I sold it to clients, and in 2008, it cost me $1.4 million. What I showed you today is a different system. 3 gears, banking infrastructure, cash flowing real estate, and tax-free income for life, working together to compress the timeline from 40 years to 10, not by working harder, not by earning more, by building a fundamentally different architecture underneath your financial life. Everything I showed you today, the banking infrastructure, the compound growth engine, the tax-free income, the death benefit that protects your family from day one, all of it together, we call this one thing: the ultimate asset, because that's what it is, not the best of a category. The asset underneath all your other assets, the foundation that makes everything else work the way it's supposed to. So here's what I want you to do. Book a strategy session with me. Here's what that call actually looks like. You and I get on the phone together, not a sales pitch, not a generic consultation, a real conversation about your actual numbers, your current assets, your timeline. I walk you through what this banking infrastructure would look like, built around your specific life. The funding level that makes sense for you, your projected tax-free income at retirement, the specific policy structure for your situation, your timeline to the crossover point where your passive income exceeds what it costs you to live. You walk away from that call with clarity, a picture of what your next 10 years could actually look like, not as a hypothetical, not as a generic framework, but as a plan built on your real life. The call costs nothing, no pressure to move forward. Whether you decide to start building infrastructure or whether you decide it's not the right time, you leave with something you cannot get from a book or a video, a plan that's yours. I've been doing this for 25 years. I work with clients in 49 states all across the country. I've helped hundreds, if not thousands, of families build the banking infrastructure that I didn't have in 2008. That's what I want to help you build. And the only way we figure out what it looks like for you is to get on a call together. So here's my ask. Book the call. Let's look at your numbers together. Everything I've built in the last 18 years since 2008 is built around one idea: never be without this. If you're ready to start building, I'm ready to help. Book a call with me. Let's get you out of the rat race. I know some of you aren't ready for the call yet. Maybe you want to go deeper on your own first. Maybe you want to share this with a spouse or a business partner before you schedule anything. If that's you, I wrote a book called Live Rich, Die Rich that walks through the entire system in detail. You can read at your own pace. Read it, share it, then come back and book the call when you're ready. But if you already know you want to look at this and see what it means for your life, skip the book, book the call. That's where the real work happens, and we'll get into your numbers.